Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, a week on from last week's show, and unfortunately that means that we are a week into Russia's invasion of Ukraine. Now, in terms of investment markets, uncertainty remains and we're seeing incredible levels of volatility in certain assets as investors struggle to price in the impact of the war and the corresponding sanctions on Russia, the impact of those on the global economy. Now, February closed with every major stock market in the red as a result of the increased uncertainty over the path of inflation and central bank responses to that, but also the path of the war in Ukraine. Now, during February, the German DAX was the hardest hit of the major Western stock markets, falling 6.53% during the month. And that's because the German economy has a significant reliance on Russian gas supplies, while its stock market index has a lack of energy companies within it. And if you recall, energy companies have been the chief beneficiaries of rising energy prices. Now, the opposite can be said for the UK, which is why the FTSE 100 was down only 0.08% during February. And to give that some context, the MSCI All Country World Index was down 2.74% during February, while the S&P 500 fell 3.14%, while the FTSE Euro First 300 was down 3.23%, and the Nasdaq 100 was down 4.64%. But if we zoom out and look at the year-to-date returns of the various indices, the established trends have continued, with the US stock market faring the worst, with the Nasdaq 100 down 12.72%, having been as low as 17.22%. But the situation in Ukraine has seen European stocks now drag lower, with the DAX now down 11.87% year to date. Now, once again, the standout performer is the FTSE 100, which is incredibly still up 0.61% year to date. Now, as the situation in Ukraine continues to escalate, we've seen increased levels of volatility across asset classes. Having revisited January's intraday low of 4,222, the S&P 500 is now finding some support around the 4,300 level. Right now, as I make this video, the index seems to be trading in the range between 4,250 and the 200-day moving average of 4,463. And the S&P 500 sits at 4,366 right now. Now, equity markets globally continue to be volatile, reacting to the news flow out of Ukraine. Now, even at a sector level, we are still seeing big swings, with investors rotating in and out of defensive sectors into the more cyclical ones and then back again. And it means that placing aggressive bets right now leaves you exposed to the potential for the market to move against you. And we are also seeing short squeezes, which then fade, resulting in strong rallies that eventually are sold into and dissipate. The market is really looking for a catalyst for the next strong move higher or lower. But it's not just about equity markets where we're seeing aggressive price swings. We've seen it in bond and commodity markets this week too. On Tuesday, the 10-year US Treasury yield, for example, sank from 1.88% to below 1.7% as the scale of the new international sanctions against Russia were revealed. Fears that the long-term effect of these sanctions would be hurtful to the global economic growth, as well as a dash for safety after Russia's nuclear threat, saw bond prices soar, which means that yields correspondingly fall. Now, it felt like a return to the historically negative correlation between bonds and equities, where there's a tendency for them to move in the opposite direction and therefore provide some diversification benefit for your portfolio. Now, while this hasn't been the case so far in 2022, with the returns from a typical bond and equity portfolio being in negative territory, bonds finally provided a boost to your portfolio in one of the biggest one-day moves in bond markets for years. Yet, just 24 hours later, testimony from US Federal Reserve Chair Jerome Powell that the Fed would indeed pursue an interest rate rise in March, despite the war in Ukraine, refocused investors' minds on the macroeconomic backdrop. As a result of the war in Ukraine, the market had scaled back its bets on the number of interest rate rises the Fed would implement in 2022, falling from 6 to 7 to perhaps 4 to 5. But this now has reversed following Powell's comments and also following an upward revision on the previously announced number of jobs added to the US economy in January. It means the 10-year US Treasury yield rebounded to 1.86% in a matter of hours, leading bond funds lower once again, at the same time as equity markets continue to show signs of weakness. Elsewhere, commodity prices have soared, with the price of Brent crude rising to $120 a barrel, which marks a 50% rise so far in 2022 and the highest level in 8 years. Wheat prices too have soared, which is increasing inflationary pressures around the world. The haven asset of gold sits at $1,933 per ounce as I make this show, still above that key $1,900 level. Bitcoin, meanwhile, has rallied back above that key $41,000 level, seemingly decoupling, for now at least, from the plight of US technology stocks. Now, the move in Bitcoin gives you a sense of how some investors are already trying to call the bottom for equity markets and other risk assets in this sell-off. Yet the market bottoms are rarely formed in a single moment, and often they are formed following a period of consolidation. So it's far too early to be certain of such things, especially when so much is uncertain with regard to the situation in Ukraine or global central bank policy decisions. Now, whatever tea leaves investors are reading in an attempt to divine the future, some of those will be positive and others are negative. So, for example, there has been a bullish divergence between the relative strength index on the S&P 500 and the index itself. Now, if you want to understand what I mean by that, listen to the Money to the Masses podcast, episodes 348. Yet at the same time, the NASDAQ 100 has just produced the first death cross in 2 years. And this is where the 50-day moving average crosses down through the 200-day moving average and is seen as an omen of worse things to come by some sections of the investment world. So is it even important to catch the bottom of a market? Perhaps it's better to avoid a potential bear market rally than to miss out on the start of a bull market rally. I mean, that's for individual investors to decide. But for now, where we go from here is still very much uncertain. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, Money to the Masses with the number 2. You can find us on Instagram, TikTok, Facebook, and of course, don't forget to subscribe to our YouTube channel.